The stock market is down big and your stomach just dropped. The number's lower than it was last month, and maybe it's a lot lower. The first thing that your brain said was, should I get out of this? And I get it, that feeling is very real. And guess what? You're not alone. And in today's episode, I'm going to walk you through exactly what you should do and what you should not do the next time the stock market goes down. This could be one of the most important financial decisions you make in your entire life. Welcome, new and returning Money Buddies. I'm your host, Skylar Fleming, and here's what I'm going to give to you today. By the end of the episode, you're going to understand exactly what a market downturn means for someone our age and why it's actually working in your favor. And even though it doesn't feel that way, it might be one of the best things to happen to you. And you're also going to know exactly what you need to do to prepare yourself so the next time the market drops, you don't do something that you're going to regret. And within my CFP education, one of the coolest areas that we learned about was the psychology behind all of our money. And as a certified psychology of financial planning specialist, I have a lot of great tips that's going to help you tackle the mental side of all of this. And if there's one thing that I want to help you with, and one way that I want to be extremely valuable to you, is to help you build a plan and stick to it. So today I'm going to help you at the side of the equation when it comes to actually sticking with your plan that you're working so hard to build. So let's get into today's episode and teach you how to handle the next market downturn. So here's where I bet you are right now. You've done everything right. You opened up the retirement account finally. You set up contributions. You started investing and you're proud of yourself. And then the market went sideways. And suddenly it feels like you've made a mistake, but you didn't. But I understand why it feels that way. So let's talk about what's actually happening so that you can actually understand it. Because I promise once you understand this, your anxiety is going to begin to shrink. So what do downturns teach us? Well, I have an article here from Morningstar about what we've learned from over 150 years of stock market crashes. And this quote says, what do we learn from recent crashes? Well, one, it's impossible to predict how long a stock market recovery will take. And two, if you don't panic and sell your stock holdings when the market crashes, you are rewarded in the long run. And both of those are very important things for us to learn right out the gate. You never know when a downturn is going to happen or how long it's going to last. So there's a huge emphasis to start out here with controlling what you can control. You can control your consistency with investing. You can control your emergency savings so that you can weather those storms, whether you're in a downturn or not. You can't control how long the downturn will last or any sort of the timing around that. But if you can get around sticking to number two and not panic selling throughout your entire life, then you're going to be infinitely better off for it. And honestly, that may be the one thing that if you get right, you'll be just fine. And there are some lessons we can learn about navigating this volatility that I want to teach you about. This next quote says here, what does history teach us about navigating volatile markets? Mainly that they are worth navigating. The stock market recovered after a stressful period in 2022, just as it did after a 79% decline in the early 1930s. So what's the point? Market crashes, while they feel scary when they happen, and there's no way to know whether it's a minor one or a major one, they will recover, even if you're looking down the barrel of the next Great Depression, or it's going to be even worse than the Great Depression. Maybe it'll be called the Greatest Depression. History has shown us that it will recover. The one thing that you can know for certain is that the market will go down and it will come back up. There's never been a downturn that we haven't recovered from. So take a deep breath and realize it's going to be okay. You might be looking over the past 6 or 7 years and thinking some of those downturns were severe, but they weren't even close to the worst ones in history. The COVID-19 downturn recovered very quickly. The 2025 tariff turmoil recovered in less than a year. And while all these things going on in our lives and in the world may seem like the truly most tumultuous time in the world, there's one thing that you can count on based on history is that the downturns will recover. There will be all-time highs again. So now that we know what history teaches us about downturns and that they will end, let me teach you about why these downturns may actually be a great thing for you because of your age and the time that you have. This next article is titled Market Drops Explained, Why Young Investors Shouldn't Worry, and it's going to help us understand what a drop is and why they're so beneficial for us, honestly, in the long run. It says, quote, is a drop the same as a crash? No, but they're similar. A market drop may be just 1%, 5%, or even 10% over a few days, but a stock market crash, Those are much more dramatic, usually involving sharp double-digit falls in a very short time. When people talk about the largest stock market drops in history, they're often referring to crashes like 1929 or 2008. Here's the thing, crashes are rare, drops are normal. I think this is important to mention so that you know not to check your stock market account so frequently that you feel like these drops are a big deal, because they're normal. So you should expect a drop every now and then. You shouldn't expect to always open your investment account and for it to be up really, really far. Because if they're always going up, then honestly we'd have a harder time making money, because downturns are a key point of opportunity for all of us young adults. This next quote says, "Should I sell during a market drop?" And it also says, no. That's one of the biggest mistakes that new investors make. And yes, I completely agree with this. Selling during a downturn is one of the biggest mistakes. Like I said earlier, if you can avoid panic selling throughout your entire life and just stay consistent, then you're going to be probably better than everyone else when it comes to retiring and making steady, consistent investment growth. So what should you do the next time the market drops? Well, the article quotes 4 big things. 1, zoom out, look at your investments over 5 to 10 years, not 5 to 10 days. 2, stick to your system. If you're auto investing monthly with an ETF or into your retirement account, keep going. Consistency beats timing every single time. 3, don't check your balance every day. And 4, consider dollar cost averaging. I think these are all fantastic tips. That's why I wanted to share all of them. And make sure you're not considering a 5 to 10 day window, because that looks crazy every single time. It can get you crazy excited because things are up over the last few days, or it can get you really anxious because things are down over the last few days. Look over the last 1 year or 5 years and see where the market has come from. That's going to help you. And most importantly, stick to your system and stay consistent. That's why a workplace retirement account is so beneficial, because it comes right out of your paycheck and you never even see it, and it's so easy to leave it alone. And I do have an article that's going to prove that to you about how consistency beats timing. So let's continue talking about these downturns, and let's also talk about why they can be so beneficial for all of us young adults. This next quote says, "Why do drops matter for young adults?" Well, when you're young, you have an unfair advantage, because as you begin investing now, you have decades for your money to grow. I've said this on countless episodes, time is your superpower. If you're listening to this right now and the stock market happens to be down, or if it's up, if you're waiting for a moment to get started with investing, do it today, and then start staying consistent through regular monthly contributions to your investing account. Because you know what's super fun once you actually get this plan going is you're going to start to see headlines about how the stock market is at an all-time high, and that means your money that you've been investing for years or months prior is up. And that's because you stayed consistent through the downturns or whatever crazy time is going on in the stock market. Remember, time is your superpower, so make sure you use it responsibly. This next article here from Fidelity talks about a guide to stock market dips and downturns. And of course, all these links to the articles and everything I've talked about today will be in the show notes. So make sure you go check them out if you want to read more. But I have 4 tips for you here to guide you through a stock market dip. 1, check on your emergency savings. 2, invest with discipline or ask for help. 3, consider saving more and rebalancing. And 4, explore opportunities like tax loss harvesting. And I really like the idea to start us off here with checking your emergency savings. We'll talk about it more here in a moment, but having savings is a great way to bear the mental load and stress that comes with a stock market dip and downturn. But all the other 3 tips have to do with having a plan and staying consistent. Because if your plan is to invest $300 a month, keep going, be disciplined. And if you keep going, I promise you're going to look at the other side of the downturn with such relief and excitement that you powered through it. And guess what? Every single downturn has recovered. But beyond your plan, downturns in the stock market can be a great opportunity for even more. You can take advantage of tax loss harvesting, or it could even be a great time to consider increasing your contributions to get some more money into the market. And if you have money sitting on the sidelines that you're just waiting for a reason to get it into the stock market, a downturn can be a great opportunity to pull the trigger. But that doesn't mean you need to change your plan and start only investing money when there is a downturn, because that doesn't work. But really, what should be happening is that you're increasing your contributions regularly and that you consistently keep putting money into the stock market. Because it doesn't matter if there's a downturn right now or if we're in the middle of a fantastic bull market. Get your money into the market and build a consistent investing plan, because the one thing that always wins out is consistency. And this next article is going to prove it, because I know what you're thinking. You're sitting there thinking, okay, Skylar, if the market's down right now, shouldn't I wait till absolute bottom and then put everything in? Shouldn't I wait to time it quite right? So let's look at the data and figure out what you should actually do. This next article from Schwab says, does market timing actually work? Charles Schwab did a study with 5 different investing styles. All of them received the same amount of money each year, and this was over 20 years. There was Perfect Peter, who was the perfect market timer. He invested at every single bottom and sold every single time at the top. And no surprise, he came out on top. But that's impossible to do. What is surprising is that the person who consistently invested every single month with no timing strategy, not trying to watch all the different charts, they came in a very, very close second. And the person who had the absolute worst timing possible and sold at all the highs and missed all the lows still had more money than the person who never invested at all. So here's the thing, the person who was the worst timer ever, their results were still surprisingly encouraging. Even if you don't do that well with market timing, you still have more money than the person who never invested. So that's what is so important. Make sure you start investing. And yes, if you are able to perfectly time the market, you're going to come out on top. But guess what? It is impossible to do that. Perfectly timing everything is not going to happen. So we have to completely ignore that result, which means the first place result was the person who took a simple and consistent approach and invested their money every single year as soon as they could. And then close behind it was a simple, regular monthly contribution with a dollar cost average approach. But the person who had the worst luck ever still made more money than the person who never invested at all. So don't be the person who never invests at all. And what does this mean for you? Well, the best course of action is to create an appropriate plan for your situation and take action as soon as possible. It is impossible to accurately identify every single market low and every single market high. It's not going to happen. So your best plan is to do the boring thing, the simple thing, and keep investing consistently. And guess what? It's not going to make any headlines. It's the boring thing to do, but it's the right thing to do. And now, what is dollar cost averaging? I want to talk about this strategy a little bit more here with an article from Fidelity. They quote, "What is dollar cost averaging? Dollar cost averaging is a strategy where you invest your money in equal amounts at regular intervals, like $250 a month, regardless of where the market is going. Over time, this helps you buy more shares when the price is relatively lower and buy few shares when the price is relatively higher, and it averages out." And if you're not sure what to do with investing, then dollar cost averaging is a great place to get started. Here's my story about this. When my wife and I first started investing, I was so nervous to put real money in. I didn't know where to invest it. So I started doing $1 a day. Just $1. I am not kidding. Did it help at all? No. But what it did was teach me that it's okay to watch the number go up and watch the number go down. It didn't help us get anywhere close to our financial independence goals or retirement. But it really helped me get to a place that matters when it comes to feeling confident investing money consistently. That's why it's so important. 3 reasons from Fidelity of why dollar cost averaging is a big deal. 1, it can help you counter the emotional resistance to taking the plunge to get started with investing. 2, it can be particularly effective through market volatility and down markets because you can buy shares at lower prices and it's actually beneficial. 3, it can help you make a regular and consistent investing habit actually stick for the long term. And number 3 is the biggest point for me here, because building that consistent regular habit is going to help you more than any amount of money that you can put into the stock market right now, unless of course you have $1 or $2 million or something like that. Then there's a whole other conversation around that. But if you're just trying to get started, starting with a regular dollar cost averaging strategy and building that consistent habit is going to be more powerful than anything else you can do, because it's going to allow you to feel comfortable and confident with actually investing money. And like I've also mentioned a couple times, another quote here says that dollar cost averaging can be a powerful strategy for a down market. When a market declines or runs into volatility, it can be easy for investors' emotions to take over. By committing to regular, periodic investments, dollar cost averaging can help take the emotions out of your investing decisions. That is a big deal. That's why your 401k is so amazing, because it goes straight through your work's paycheck. It's consistent and keeps you on track. You don't have to worry about what the stock market is doing because you just let it keep going and do its thing. And now I want to tell you a little bit about how dollar cost averaging actually plays out during a real crisis. Not just a downturn or a stressful time in the stock market, but let's look at the 2008 global financial crisis. How did dollar cost averaging fare? So there's 3 scenarios that I want to walk through with you here. There's a stick with it and dollar cost average through the crash. There's move your money to cash and continue contributing cash, or there's move to cash and stop contributing altogether. The person who moved to cash and stopped contributing altogether ended up way below the break-even point when the financial crisis started. The person who moved to cash and just continued at least contributing to their account ended up just barely above break-even, which might be okay, but honestly, there's a way better approach. The person who continued contributing and stuck through it with dollar cost averaging ended up way far and above anyone else. So if something as stressful as 2008 can be overcome through a simple dollar cost averaging approach, then stick with it. Stick to your strategy and just keep going. And just remember, the stock market will always recover. It's always recovered in history. So just stick with it and keep going. So if something as stressful as the 2008 financial crisis is able to be overcome through a simple approach of dollar cost averaging, then I promise whatever market turmoil or ups and downs we're going through when this releases or in a couple of months, it will also be able to be overcome by a simple approach and a steady, consistent investment approach through dollar cost averaging. And of course, knowing all of this is one thing, but actually being able to sit there and watch your balance drop and not do anything, that's completely different. So let's talk about the emotional side to all this, because that's where it gets so challenging. The last article here in today's research comes from Morningstar, and it's titled Managing Your Stock Market Psychology. There's some common mistakes, and I want to help you be aware of these, because if you can be aware and avoid these, you're probably going to be okay. There's 5 things. 1, changing the portfolio inappropriately. 2, selling winners early and holding losers for too long. 3, not actually understanding your investments. 4, getting swept up in the market and news frenzies that are going on. And 5, feeling hyper loss aversion. So if you can remember these 5 potential mistakes and try your hardest to avoid them, you're probably going to be okay. And just remember, you don't actually lose money until you sell it. So if the investment appears down, don't sell it and you haven't claimed the losses yet. But make sure you actually understand what you're investing in. And don't just listen to what your coworkers, friends, or family, and especially not the news. Don't listen to them when they're trying to tell you what you need to get out of or what you should be invested in, because the overall stock market is going to recover. If you're trying to invest in single stocks and individual companies, then yeah, that can be really difficult and really hard to figure out. But if you're investing in the economy as a whole, it's always recovered. If we look at history, which of course past performance doesn't guarantee future results, but every single stock market downturn has recovered. And you're going to see exactly in today's case study what happens when there are 2 coworkers, one who wants to time the market and try to predict it all, and one who continues with their steady dollar cost averaging approach. And right here as we finish up, I have 5 mental tips for you to help you through investing in a downturn. 1, keep a cash reserve out of the market. 2, don't take risks you don't understand. 3, plan with a partner. 4, watch out for herd mentality. And 5, keep market conditions in perspective. It's very important to keep your cash that you need out of the market, especially if you have a job loss that coincides with stock market turmoil, which is common. It's also very important to plan with someone else, whether it's a financial planner, a spouse, or a trusted friend. Make sure you're on the same page and that your goals align and that you understand each other's goals, because you don't want to talk with just anybody about stock market news, or someone might sway you to jump out of the market when you don't need to. Because if you're just talking to anyone and everyone, that's when herd mentality can start to kick in. And you're going to start to feel pulled in all sorts of different directions. And a pretty good tip that I've learned in life is that if a vast majority of people are doing one thing, it's probably good to consider doing something different. So no matter what's going on in the stock market, make sure you keep all of this in perspective. And remember, it's always recovered. There's never been a time in history when the stock market has not recovered from a downturn or even a Great Depression. So no matter what you take away from today's episode, just remember to stay consistent and keep investing. And that's going to help you get through whatever seemingly catastrophic financial situation is going on in the stock market. But that does it for today's research. I hope you enjoyed and I hope you learned a lot. The case study today is going to help you compare 2 people, one person who did nothing and one person who tried to time everything perfectly. And you probably know exactly how this is going to turn out, but let's get into the case study next. Let's get into today's case study and introduce 2 people to you. There's Dani and Brett, and they're both working a similar position in Tennessee. And they started working together about a few months from each other. They're similar salaries, and they became friends quickly at work. They eat lunch together, they talk about life, work, and occasionally money. And about a year before this story takes place, both of them opened a Roth IRA after listening to various personal finance podcasts. Neither of them had invested before, and they both decided to contribute about $300 a month and just put it into an S&P 500 index fund, which is great. They both got started on the right foot. They felt good. They were proud of themselves. Their balances were growing. The market had been on a nice run, and it felt too easy. They were glad they got started, but they weren't sure what all the hubbubaloo was about with investing being hard. And then early 2025 arrived. You'll remember about a year ago when all the tariff announcements were starting to hit the news. Well, that's where this all starts. Because at this point, Dani and Brett had been investing for about a year. They both had just shy of $4,000 in their Roth IRA. Nothing dramatic yet. They weren't ready for retirement or anything like that. They're both young adults in situations like you and I. Dani had done something that felt small at the time, but it's going to turn out to matter a lot. When she first opened her account, she had heard that it was a good idea to write down why she was investing. She wanted a down payment for a home someday, but she knew she needed to start setting up her retirement savings because she didn't want to have to depend on anyone. So she set her contributions to an auto transfer on the first of every month so that she wouldn't have to think about it. And she told herself she wasn't going to check the balances more than once a month because she knew herself well enough and knew that she would get stressed out and anxious if she was looking at it all the time. Now, Brett, he had set up contributions in the exact same way, but he was extremely plugged into the financial news. He was following several investment accounts on social media, and he had instant alerts set up on his phone for market moves, which was a bad idea. He felt like he was informed, and so when the markets started to get choppy, he started paying even closer attention. So this is where the difference lies. One person set up a system and just stuck with it, and then another person decided to be extremely plugged into the news, which is honestly never that good for you. So let's move into the mental battle that both of these people start to face. Well, in March, like you knew, the tariff news was escalating fast. The S&P 500 went down a sizable amount. Brett's balance had gone down from roughly $3,800 down to about $3,200. And he looked at his account several times per day, and it was just stressful and gut-wrenching. And during lunch one day, Brett pulled out his phone and showed Dani the chart. He said, "Look at this. It's just continuing to drop. I think I'm going to pull everything out to cash, wait for it to hit rock bottom, and then buy back in." Dani looked at the chart and she felt the stress, right? Like all of us, she's not immune to anxiety. Sure, she had her system, but it's still stressful. And she told Brett something that was extremely insightful. She said, "Brett, how are we supposed to know when the bottom is?" This is an incredible insight, and it's something we should all be thinking about during downturns. Now, Brett had his answer ready. He had been reading online threads, watching YouTube videos. He knew that the evidence was clear that things were going to get worse before they got better. So he did it. He sold everything in his Roth IRA and moved it to cash. And he told his coworkers that they should do the same. Well, Dani went home that night and she genuinely thought about it. She stressed. She decided to look at her balance. It had also dropped. But then she found the note that she wrote herself when she opened the account and she reread it. She didn't love what she saw in the account, but the note helped her keep her auto contribution running. For the next several weeks, Brett watched the market obsessively, stressed out, not sure when the bottom was going to be because he was ready, hoping he was going to be the one that made the right call. The market kept dropping. He felt excited that he knew he made the right call. He started telling Dani that he was going to wait until things were very clear and then he was going to get ready to jump back in. Now, Dani kept investing $300 a month. In March, April, and May, her contributions bought more shares than they ever had because the prices were on sale. She tried not to think about it too much because some months she felt extremely nervous, some months she felt fine because she was able to ignore it, but she just kept going. And now come the results. So picture the timeline of about June through December 2025. This is where Brett's plan ran into a wall and where every market timing strategy eventually falls apart. There was not a clear signal that the market was recovering. It started to move up and down in choppy and uneven waves. One week it was up 3%, then it would drop 2%, then it would jump up again, and it would be extremely stressful. Brett was trying to wait for that clear confirmation to buy back in because he wanted to be certain that the worst was over. By the time he felt confident enough to reinvest, the S&P 500 had already recovered much of what it had lost. He bought back in around July. Prices were significantly higher than when he sold, but he had locked in his losses when he sold, sat in cash during a meaningful portion of the recovery, and then bought back in at higher prices. He had done the worst thing possible. He had done what everyone fears. He sold low and bought high. Now, Dani, in the meantime, kept putting in her $300 because prices were down for several months. Her contributions were buying more than they ever had. So when the market recovered, those shares looked extremely valuable and they were worth more than any of her previous contributions, which was exciting to Dani. So by the end of 2025, Dani's Roth IRA was noticeably ahead of Brett's, even though they started at the same place, earned the same income, and contributed the same amount every single month. The only difference was what they did during those few scary months in the middle. And now, of course, Brett was frustrated, not because the market punished him, but because his plan felt so logical and great in the moment. The hardest part now is knowing that the information he had might have been correct, but now he realized that no one, including him or any news outlet, could exactly predict when the bottom would be or when the recovery would be. The ones who win during downturns are usually the ones who do the least. So what is your biggest takeaway here? For me, it's that consistency is key. The only person who beats the consistent person is the one who gets magically impossibly lucky, which, like I said, is impossible. So the person who's going to do the best during whatever market downturn we're about to have is going to be the one who sticks to their plan consistently. That's why it's so important, like we talked about with today's research, to have emergency reserves and cash, just in case you need it. Because if you're able to stick through your investing plan through whatever market downturn is going on, you're going to be the one who's successful, and you're going to be the one who has money ready for retirement. So here's your quick win from today, and I want you to do this before you go to sleep tonight. Open your notes app or grab a piece of paper and write down 3 things: why you started investing, what you hope this money becomes, and a reminder to your future self of what to do when things get scary. Because of a very similar note that Dani went back and read, she was able to stick to her plan. It doesn't have to be something fancy. It can just be a simple few sentences wrote down to future you to help you make a decision when things get rocky. And I've had previous episodes on this, so be sure to go check out episode 1, Crafting Your Financial Why, and episode 22, the one question that will change how you handle money. So go back, check those out, and write down why you're investing money and what you want to use it for in the future. And the one action item for each and every one of you today is to write down your investing plan so you have something to refer back to during the next market downturn. Make sure it includes, at the very least, what you're investing for, where you're investing, how much you're investing, and when you're making those contributions. And now, the next time things get scary, instead of sharing financial news and crazy financial headlines, share this podcast episode with a friend so that when there's a downturn, they know what to do. Instead of having your coworkers and friends share crazy financial news, you can be the one that's pointing them in the right direction to make sure they don't do anything during the next market downturn that they'll regret. I really hope you enjoyed today's episode. Next week, though, we're moving on to even more beyond investing, because when most people think about financial planning, they just think about investing. It's an unfortunate side effect of the way the industry has built itself up, but there's so much more to financial planning than just investments. That's exactly what we're going to talk about next week. Whether it's going beyond investing with things like insurance, estate planning, cash flow planning, or tax planning, there's so much more to think about. So next week, we're going to learn about all the other areas beyond investing. And thank you for listening to this week's episode of Financial Planning for Young Adults. I'm your host, Skylar Fleming. Have a great week. And hey, quick heads up. This podcast, it's meant to be educational and it's for entertainment purposes. It's not personalized financial advice for your specific situation. So before you go out and make any big money moves, make sure you chat with a qualified financial professional who knows your full financial picture.